Hello, welcome to Any Answers Answered for October 2019. Two questions as ever from the pages of Any Answers on accountingWEB that Tim and I are going to have a look at. Our first question this month comes from an Ian B, who asked a question about remuneration or dividends. Dividend paid by the client, an OMB, when there was cash available but no reserves. I believe, says Ian, that the dividend is repayable and should be accounted for as a debtor in the accounts. The amount due subject to 455 tax and therefore a director's loan kind of arrangement. Although the dividend is unlawful, in my view, it is still a dividend, in which case the shareholder director is still taxable once dividends exceed the £2,000. The question then, Tim, let's do the two questions there really separately. First of all, they've paid out a dividend, there was cash but there were no reserves, and he's saying it should be repayable and therefore should go on as a loan?
This issue of unlawful dividends has cropped up over more years than I care to remember. So what we have to do is look at case law relating to loans and debts to companies and also the revenue guidance on this area. And if the shareholder in receipt of an unlawful dividend was unaware that it was unlawful. So let's suppose instead of being a controlling director shareholder, it is just a small shareholder in a large company and they receive an unlawful dividend, then there is no question but for the fact that it is a dividend and is taxed as a dividend and they don't have to repay it. Mm-hmm. But in law, subject to the most recent Supreme Court decision, I gather that where a director shareholder receives a dividend knowing that it is unlawful, then they in fact hold it as constructive trustee for the company. So they would then be required at the company's request to repay it. But what has never been entirely settled is whether the holding of the amount in question as constructive trustee triggers Section 455, the loan to participators. The revenue view, however, is clear. It's set out in the Corporation Tax Manual, Chapter 15205, which says that where a dividend is unlawful in whole or in part, and the recipient knew or had reasonable grounds to believe it was unlawful, then the shareholder holds the dividend as constructive trustee. And they go on to say that where the company is a close company, it is regarded as having made a loan to the shareholder by virtue of Section 455, subsection 1, therefore triggering the subsection 2 charge for loans to participators. So the clear revenue view is that in a case like this, the unlawful dividend does indeed constitute a loan to the director shareholder, and therefore, unless it is repaid within the relevant period, which would be 9 months of the year end, there will be a Section 455 charge that will then be repaid to the company after the director has eventually repaid that dividend.
But presumably there would be no tax under the dividend rules.
In the meantime, you're right, it wouldn't be taxable as a dividend because the revenue would treat it as a loan to the participator, not as a dividend to a shareholder.
Exactly. So when I first read it, I couldn't decide which of the two it was, but it certainly couldn't be both. The conclusion is exactly that point. It cannot be both. It cannot be a dividend and also a loan. And therefore, for the time being, the 455 tax would be due, the 32.5%, but not a tax against the individual director. And our second question comes from a Mr. Hunt. And the question is, I understand that if a person gives a friend £250,000 as a gift, there is no tax liability, providing, of course, they survive 7 years. Fine, no problem with that. However, if the friend draws the money out of his company to his friend, then I guess, says Mr. Hunt, a different set of rules apply. What do you think, Tim?
Well, I think Mr. Hunt is absolutely right. And although inheritance tax is usually thought of as a tax applying where an individual makes a transfer to another individual, that in fact is just one admittedly very large subgroup of dispositions that fall within inheritance tax. And if a close company makes a gift or a sale at undervalue, for example, a close company might own a property and the property has a market value of, let's say, £500,000, but the company sells it to one of its shareholders for £250,000, well, that would constitute a disposition by virtue of the sale at undervalue to the extent of £250,000, and the legislation in Section 94 IHTA 1984 provides that that disposition is apportioned to the participators and treated as made by them. Now, you might then think, all right, if there is a gift, whether it's an outright gift of cash or sale at undervalue by the closed company to the friend, that will then be treated as a transfer by the director shareholder, and for simplicity, let's make it a sole director shareholder, so we're not having to split it between different shareholders. And as long as it's within the nil rate band of the director shareholder, there'll be no consequence, and it's a potentially exempt transfer, and if you survive 7 years, that's okay. But there's a key point. The apportioned transfer under Section 94 is in fact a chargeable lifetime transfer, and so if it exceeds the nil rate band, it will in fact trigger an immediate tax charge. Now, if the £250,000 is the only gift that the individual has ever made, then it's not going to exceed his nil rate band, and so that'll be okay. But if there were other gifts, it might, and on death within 7 years, then there will be the appropriate consequence. But it is a chargeable lifetime transfer rather than a potentially exempt transfer.
So the point is, if he had previously given, let's make it very simple, £325,000 somewhere, then he could be looking at 20% on this donation because of the structure which he's actually allowed for. A potentially very important point. And as many people looking at the comments on accountingWEB, people haven't always thought this through as being a potential issue. People assume that because it's ended up in the person's hands, it must be exactly the same, but it is not. It is a very different treatment. If you write a question on there in the next month or so, then perhaps next month Tim and I will consider the answers and offer it in next month's Any Answer Answered. But for this episode, bye-bye.